Good evening, everyone, and thank you for joining this call. Um, so, I will cover the monetary policy today, and I will also cover the ongoing global macroeconomic developments in the context of the heavy tariffs that US has imposed on most of the rest of the world. So, let me first, begin with the monetary policy review. So, it was unequivocally a dovish policy where not only were rates cut by 25 basis points, as was widely expected, but the MPC also changed stance of monetary policy from neutral to accommodative, which basically means that going forward, the decision only is whether to hold rates or to cut rates. Our sense is, and I will explain further, that there's potentially another 50 basis points of rate cuts on the table for the rest of this calendar year. So earlier we thought 575 could be the terminal repo rate. Now we think it's going to be five half. And like I said, I'll explain the reasons why. In other notable, part of the assessment of the monetary policy review, so the MPC now is quite comfortable on inflation. It's owing to a host of reasons. So you have had, a fall off in commodity prices, vegetable prices have come off, the Rabi season has gone off well. And all told, the MPC or rather the RBI projects 4% inflation for the year forward. Importantly, inflation expectations as measured by RBI for both the 3-month and 12-month horizons have also fallen. Clearly there is great comfort now on inflation, although there is a bit of worry on if rupee were to weaken, what imported inflation we could face, but really it's just a very marginal worry. Also importantly, the governor interpreted for us what the tariffs will mean for growth versus inflation for India. And largely, the impact that the RBI and MPC seem to be worried about is with respect to growth and not inflation. So what they basically are saying is, first half of last financial year, as we know, growth had slowed very substantially. It was beginning to recover over second half, and then this entire tariff situation has come about, which can impact growth in a variety of ways. So it can impact through the confidence channel, which subdues investments. It can impact through direct drawdown of export growth. It can impact growth through volatile capital flows, etc. Whereas on inflation, like I said, there is broad-based comfort. The only point that they noted was if imported inflation component goes up on rupee weakness. So the important, interpretation RBI is doing for us is that the tariff escalation is largely a growth problem for India, and the RBI is approaching it as such, which means that they have now shifted to accommodative stance. Like I said, it's very likely they cut another 50 basis points over the course of the next three policies or so. Importantly, liquidity is now surplus, and the RBI seems to be targeting an adequately surplus, or rather abundantly surplus, I should say, liquidity environment in order to be able to enforce transmission of the rate cuts that they do. Our own assessment is that RBI will want to keep liquidity between 1 and 2% positive of net demand and time liabilities of the banking system. Uh, the governor was pushed on this question. He more or less said that, roughly around 1% of NDTL they'll be comfortable with, but, it could easily go to even higher amounts. The other comfort you have, basis today's policy and the actions that RBI has undertaken to shore up liquidity over the last 2 to 3 months, is even if, let's say, there is a phase of INR weakness and RBI is forced to sell dollars to the system, which incrementally reduces rupee liquidity, they will be proactive in creating rupee liquidity through the tools they have at their disposal, largely OMO purchases, but also probably FX buy sell swaps. So all told, a very happy RBI policy as far as markets are concerned. It's a very, kind of a reliable framework they have put in place, a predictable framework they have put in place. So there is a bit of a haven of certainty in what is otherwise a very uncertain world. And let me now turn to this uncertain world, because obviously it is top of mind for everyone. Now, as you know, and this is evolving every day, hardly half hour back or 45 minutes back, China has escalated tariffs on the US. But suffice to say that it's a heavily volatile situation. The order of tariffs that are getting put in place today are unprecedented, much in excess of what even conservative analysts would have forecasted, and probably by definition, therefore, cannot last for too long. but such is the situation as of now. In this context, we need to ask and analyze three or four very important questions, and I will do so one by one to the best of our abilities. The first is, what does the US Federal Reserve do in an environment like this? So, as the US has had a very large inflation episode. Developed markets in general have had it, but US has had a more severe inflation episode over 2022 to 2024, uh, or rather, mid 2024. Things were beginning to stabilize. Inflation was coming off. US had started to cut rates, but even before this, tariff issue got escalated, US inflation was still running ahead of target, and the Fed was hopeful that it will come to target, but it wasn't there yet. Now the tariffs, have a dual shock. First, they raise prices, and second, they slow growth. So, in some sense, both sides of the Fed's mandate, which is price stability and PCE inflation at 2% and maximum employment, are under threat because of this situation. Now, in terms of Fed policy framework, what they say is that if the mandates are in tension, which means that you are seeing high inflation and weaker growth, in some sense, then how they will act is which of the two variables in their mandate is farther away from target, and in their assessment, how soon or how long will it take for each variable to come back to target. So, depending upon their assessment on these two things, they will choose to whether go after inflation control or containing the damage to growth. Now, prima facie reading of the situation, you may say that, look, they already don't have a handle on inflation yet. We have had a very large inflationary episode in the past. Tariffs will lead to 100, 150 basis point of rise in inflation at least, and risks, further pass-through effects later on. So the Fed should focus on inflation. On the other hand, if you see, although growth has held better in the US than many forecasted, in fact, we have been growing above potential in the case of the US for some time. The labor market has been relatively strong at 4.2% unemployment rate. But if you scratch the surface, all is not well. So if you take the labor market, generally speaking, both hirings and firings have dropped very notably over the last few months, which means that it's a labor market that is pretty much frozen. People are not quitting, people are not joining, and whoever is getting laid off or wanting to join is finding that it's taking that much harder to get a job. So what you're seeing in the US already for some time is what we call continuing claims. So people who are unemployed, who file for claims of employment benefits or unemployment benefits, those continuing claims have been rising. Now, on an already frozen labor market, if you impose a growth shock of the order that tariffs bring, you could potentially see a situation where unemployment rate rises. So the Fed will have to solve for this tension between the two mandates, and it's a tricky one to solve for. On the one hand, we think prices can go up as a direct impact of tariffs. However, and transitory has become a dirty word in macroeconomics because of the Fed errors of the past. However, with growth slowing and demand slowing and income growth slowing, it's very unlikely that second order effects of these tariff hikes are very large. On the other hand, whatever unemployment rise happens, it may take that much longer for unemployment to come back to a lower level, given the uncertainties that will persist in the system long after this initial tariff burst has been unwound. So our sense is, and this is what you pick up listening to Fed leadership, that what the Fed is currently focused on is looking at market as well as survey-based inflation expectations. Now, short-term or near-term inflation expectations have justifiably risen because of the impending price hikes. However, the medium and long-term inflation expectations so far remain anchored. And if that remains the situation, then our sense is the Fed will be in a position to act on growth or the risk of unemployment rising and cut rates. At the time that we are holding this interaction, markets are pricing in roughly between 4 and 5 rate cuts from the Fed over the next 1 year. And we think that's probably justifiable given the analysis that I just presented. However, one thing is reasonably certain, that in the face of this growth shock, the so-called Fed put, which is that the Fed will make everything better again, is definitively going to be weaker than the Fed put that we have seen in previous growth shocks. And therefore, risk assets will have to contend with this uh, reality that even though the Fed may cut to shore up employment in the system, if it feels that long term inflation expectations are anchored, yet it is unlikely to launch any sort of a big bang bazooka as it has done in previous growth shocks. And therefore, the size of the Fed put is weaker. Turning next to the second question, which is what should the dollar or what will the dollar do in an environment like this? Now, remember, the classic template is when risk off happens, US dollar strengthens because of flight to safety, right? So, you would therefore expect that the US dollar strengthens into the current tariff shock because of flight to safety. However, so far, what you have seen over the course of the last few days and weeks is a bit of a mixed reaction. So, in the first go, the US dollar had actually weakened. Then over the last week, there were some days that it rebounded very sharply, and then the last day or two, it's weakening again. So the price performance of the US dollar has been quite mixed, and not what conventional theory may suggest that US dollar strengthens into a risk-off environment. Having said that, we have very short period data, so who knows what happens. But let me just offer you certain factors why we think the dollar may not be responding very strongly to the risk-off environment. So, as you know, and as we have spoken in the past, in January, we put out a detailed presentation on this as well. That the US has been running on a so-called exceptionalism trade, which is that over the past few years, people have felt that the US economy is stronger, doing better, its companies are the best around the world, and therefore a lot of global capital has gone and sat in US assets. So it is almost an over-owned trade, the US exceptionalism. And what is also happening now is that exceptionalism thesis is breaking. So people are realizing that because of tariffs, because of migration getting stopped, uh, because the fiscal stimulus is not as large as what you would have initially thought, because of a variety of these reasons, the US is no longer that strong a growth engine that you had initially thought. And therefore, all these overweight positions that are sitting in US assets may want to find partly a new home or diversify a bit away from the US. So, what you may be seeing today is the confluence of these two opposing forces. One is the natural tendency for the dollar to strengthen in a risk off environment. However, people wanting to diversify a bit away from the overweight position they have had on the US, owing to some breakdown or some putting back of the US exceptionalism trade. So we hope that a combination of these two forces will imply that the US dollar does not strengthen much into this risk off episode. So far, we are encouraged by what we see, and that is important because, as you know, if the dollar were to strengthen and the INR were to weaken, then RBI will have to again come and defend the rupee, sell massive amounts of dollars, and therefore it will not be able to loosen financial conditions at the pace it may want to. So to summarize, we think we are optimistic that you will not see a runaway strength in the US dollar because the US exceptionalism trade breaking down is to some extent countering the flight to safety logic. The third and very important question, also of interest to India and INR, is will China devalue the yuan? Now, this apprehension has been in play for some time, and especially over the last few days, as tariff escalation has happened, and briefly China set the yuan at slightly higher or weaker than the normal trading band. So there is some renewed speculation that China may devalue the yuan. Now, why is that important to us? India being a big trading partner with China, if the yuan were to substantially and suddenly weaken, then there'll be pressure for INR to weaken as well, with subsequent problems with respect to capital flows in this country. That said, however, we are currently of the view that it's very unlikely that the China authorities will actively devalue the yuan. And the reason I say this, let me just explain. So, China last consciously devalued the yuan almost 10 years back in 2015. Now, the repercussion of that on Chinese capital account was actually quite large. So, remember, when a large country actively devalues its currency, in some sense, it is sending a message to offshore capital investors into the country that we are actively reducing the value of investments in my country. And that is very damaging to confidence of offshore investors into a country. And that's exactly what had happened in the 2015 devaluation episode, that for some period of time after that devaluation, China had seen a massive outflow of capital from its capital account. uh, so therefore, any such decision will have to balance whatever advantages you get on the trading side through a weaker currency with the loss of capital that you will experience because of loss of confidence. And we think the net sum of this will be that China may decide not to devalue the yuan, especially also because they may be wanting to position the yuan as a dollar alternative for global trade. That said, what we are saying here is they will not consciously devalue the yuan. Some weakening of that currency because of trade wars is very well justifiable and should happen and will happen. So I'm drawing a distinction between an active one-time policy-driven devaluation versus a gradual weakening that happens because of the trade war. So that's another thing we think should not happen, and therefore INR should not come into any extraordinary pressure because of a sudden devaluation or so forth of the yuan. The fourth question, therefore, you have to ask is how much room does RBI really have to cut rates, right? Or generally to ease monetary policy. Now, we think there are two or three factors you have to keep in play. First of all, this thing that US India interest rate differentials will narrow or have narrowed, and therefore capital will flow out of this country. This thing should have been put to bed over the last couple of years. You have seen 200 basis point, or actually on policy to policy, you have seen 100 basis point rate differential between India and US over the last 2 years at one point, and capital flows were just fine. So it's well understood by global investors that the US is experiencing very different inflation and fiscal dynamics, and because of which the rate differential or policy rate differential between a well run or well macroeconomically run large market like India versus the US can very well be lower. And investors are happy to accept that, as you have seen over the last couple of years. So one aspect that India can only cut that much because US is cutting that much has been put largely to rest in our view. Second is, does fiscal policy have room, or is most of what heavy lifting will happen has to happen by RBI? Now we strongly believe that the government will and should toe the conservative fiscal line. Too many times in India's past, governments have been tactical about fiscal compression, and at the first sign of trouble, they have loosened fiscal compression or gone back to fiscal expansion, with a result that we have not been able to cultivate fiscal credibility for long, at least till now. However, for the last 5 7 years, the government has worked very hard to get fiscal credibility back. So we saw them being very pragmatic with fiscal expansion during COVID. Post COVID, they cleaned up their financial accounts, made them more transparent, and undertook rapid fiscal consolidation. And now they have given a 4 5 year roadmap for debt to GDP reduction. Now we think that is exactly what needs to be done if over time you have to gain the kind of fiscal credibility that gets you, lower cost of capital and FPI flows on a sustained basis. And this is not worth compromising upon for 20 30 basis points of expansion. So we think, what may happen is, suppose growth slows substantially and tax revenue slow, then there may be some natural fiscal expansion because it would not make sense to cut expenditure into slowing growth, and therefore whatever amount of tax slowdown happens will show as fiscal expansion. But we don't think that absent a growth shock of a large magnitude, the government will tinker with active fiscal expansion. So that is where we think the government will draw the line, and therefore RBI still has space, and RBI will use that space. So not just another 50 basis points of rate cuts, but we think it will also be combined with active liquidity infusion. Also, if our interpretation on the above points 1 2 3, which is that the Fed will respond to employment weakening and cut rates, the dollar will not strengthen extraordinarily into this because there is a US exceptionalism trade breaking that is also happening. And we don't think there is active devaluation of the yuan that will further pressurize the rupee. If we are right on at least two of these three things, then it will also mean that RBI space will not get compromised. and the RBI will be effectively able to transmit policy easing into India, or broad based system as well. Now, therefore, turning to some conclusions. So to summarize, this was a policy which was unequivocally dovish. So not only did they cut rates, but they changed stance. Furthermore, their interpretation for the tariff shock is that it is more concerning for growth than for inflation. On liquidity, we think RBI will now sustainably run between 1 and 2% of deposits as positive liquidity. We think the terminal repo rate is now likely to be 5.5% instead of our earlier forecast of 5.75. And that too, if the global growth shock becomes much stronger than we currently forecast, then it could be even lower. But that's not the base case for now. As far as the ongoing tariff wars are concerned, there are four big questions that we have delved on today. First is, what will the Fed do? We think the Fed will have to respond to employment weakening, although the magnitude of cuts will be more conventional and not the big bang bazooka that they have done to previous growth shocks. Dollar should not strengthen extraordinarily, the yuan should not get devalued, and RBI should find the room to ease monetary policy to the extent they can. Now, let me turn very briefly to markets. So, there are, a couple of themes that we were playing till very recently, and some of them have worked out quite well. So I just wanted to discuss them as well as how some of the changes we are making. So, for a long period of time, we have held two theses. One is that we want to build duration via the government bond curve because the demand supply dynamics for government bonds is the best. And on the corporate bond curve, there was significant inversion. So you would recall in the month of February, March, your 1 year bank CDs were around 760 to 765, whereas 5 year corporate bond yields were around 730 to 740, which meant that 1 cross 5, 1 cross 10, there was a 25 to 40 basis point inversion. And our view was that come April quarter, that inversion will start to correct. And therefore, it made much better sense to own 1 year, 2 year corporate bonds, but build duration via government bonds. So you would have found in a host of our products, that's what we were doing. Now we are happy to report that that envisaged trade has played out. The inversion on the corporate bond curve has largely corrected. As we speak, your 1 year bank CDs are of the order of 685, whereas 5 year corporate bonds, depending upon which issuer you are talking about, is roughly in the vicinity of 7%. And therefore, we have used this opportunity over the last few days, and it's all part of disclosed public portfolios, to increase exposure to corporate bonds and reduce exposure to bank CDs in whatever products we were playing this trade on. We continue to like government bonds for duration, especially the long end of the government bond spread to the 10 year point has widened very substantially. And we think, therefore, valuations there are quite attractive. Bear in mind also, where you have no duration caps, it makes sense in our view to run long duration because you get maximum participation. Where there are duration caps, you have to build duration more carefully. A last point before I open for questions, as always, we think first the quality curve rallies, and credit spreads may widen into this for no other reason but the fact that credit is largely a little slower to react to monetary easing. And as transmission becomes more broad based, that is when credit spreads may stabilize to some extent. There may be company specific variations depending upon how businesses get impacted from tariffs, but that is something that each fund manager will have to be looking at closely from their portfolio standpoints. So that's really what I had to say.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.